This is Ken Boyd, the owner of St. Louis Test Preparation. This is Consolidations, Our Comprehensive Problem, and this happens to be part 3 of the video. So we've covered unrealized gains and losses in the last video. We started to cover consolidated retained earnings. So I'd like to continue on that discussion. We had talked about the beginning retained earnings for the sub XYZ and the ending retained earnings as of 12/31/2012 that agrees to XYZ's beginning balance here, which would be for 12/31/2012. Now, if I keep going, we have to eliminate an unrealized profit because we're starting with XYZ's retained earnings. XYZ had an upstream sale to the parent of inventory. That inventory had a profit in it, and that has to be eliminated. It's $13,500. If I go to this tab, unrealized gains and losses, there's that upstream sale and opening inventory sub XYZ to Acme. So that's the $13,500. The fair market value differentials are on the general info tab, which is over here. Here are my fair value adjustments for these assets. And you'll have to remember that while all these numbers are positive, some of them are actually negative. I believe, for example, that equipment actually had a fair value less than fair market value. So although these are all positive, when they get transferred into financials, some of them, the signs change. So when I go back to consolidated retained earnings, you'll see that the equipment fair market value at acquisition is less than book value, so amortization is actually an addition rather than a subtraction when you amortize. So the sum of these amortizations, 41,850, and then I get a subtotal of XYZ's retained earnings, which is the adjustment to bring XYZ retained earnings up to 12/31/2012. I'm subtracting the gross profit on the intercompany transaction on the upstream sale, and I'm also subtracting for amortization of the fair value differentials. And you'll see that 80% of that adjustment to the subs earnings goes to the parent because we're using the equity method. And Acme bought 80% of the total company, which you'll see on the general information on the general info tab. And so what's left over goes to a non-controlling interest, 20%. Now, we also had a downstream profit that we need to eliminate. The profit there, which was an opening inventory of 21,000. If I go to the unrealized gains and losses, in opening inventory, there's that downstream sale, Acme parent to XYZ sub, unrealized profit of 21,000, which gets reduced. So the problem used an abbreviation here that says equity pickup since acquisition, which means that Acme had their share of the subs earnings, 80% of the subs earnings in blue, less Acme needs to subtract the profit it recognized in the downstream sale. So both of these apply to Acme. So what we end up in red here is, with what we end up with in red, is Acme's portion of retained earnings, right here, less unrealized profit on that downstream transaction on Acme's books, 532, 552, 320. I take Acme's retained earnings at 12/31/2012 from up above. The 6,358,000 comes from here. Acme balance sheet beginning retained earnings, which would be 12/31/2012, the 69,58. So my consolidated retained earnings are Acme's retained earnings in green that I got from the balance sheet at the top, plus Acme's share of retained earnings in red, 552, 320. So there is my consolidated retained earnings number, about 7.5 million. Now, I can also consider and think about the non-controlling interest equity. right here. We start off with the NCI. I'm going to use the abbreviation, non-controlling interest, retained earnings when we acquired the company, which is 20% of the market value, so that's $791,400. Is the non-controlling interest share of the market value of the entire venture. So if I click on the cell, the $3,957,000 was the total market value of XYZ's common stock, and if 20% of that went to the non-controlling interest, that would be $791,400, which is where I get this number for the non-controlling interest. I'm going to scroll up just a little bit so you can see. There we go. Now I can get it on the page. The share of the non-controlling interest tab from XYZ's retained earnings is the $143,330, which we just figured out right here. The increase in the sub's retained earnings, non-controlling interest gets 20%. Then I add the share of the sub's retained earnings since acquisition. There's the 143 up above, right here. The 791 is 20% of the sub's market value, which we saw on the general info page at the top to try to tie those two together. And so we add them up, and we get the NCI's equity balance as of 12/31/2013. We started with 2012. Let's go on and think about net income. We have the subs net income, which comes straight from the income statement tab. So net income, $228,000. If I look at that cell and I go to income statement retained earnings, and I scroll down to in red where it says net income after taxes, XYZ, there's the $228,000. I then have to make adjustments to that net income for the unrealized profit. Now, this brings up an important point. When I sell inventory to an outside third party, in consolidation, once it's in the hands of a third party, I would recognize properly the profit because no longer is it an intercompany issue. We can now recognize a profit because we sold it to the outside world, so to speak. So the profit on opening inventory actually gets added because the opening inventory is assumed to be sold to a third party during the period, the opening inventory. And we already saw that 13,500 XYZ sale to Acme. Now the profit in the closing inventory is deducted or reduces net income because that profit is not yet recognized because it's in ending inventory, which means by definition the good has not been sold to the outside world. Therefore, we need to reduce and eliminate that profit. Unrealized gain on equipment sale is deducted. If I go back to the gain and loss calculation, I see that the sub XYZ sold equipment to the parent. So that in consolidated net income, we need to eliminate that. That's an intercompany gain. And we also have a deduction for the amortization on that gain. We have amortization of the fair value differentials, which you saw on the unrealized gain and loss tab. So for example, for equipment, the 11,000. Got to go over one more tab. And right here. There's my equipment amortization 2013, 11,000. consolidated net income, equipment, 11,000. So these are the 2013 amortizations of the fair value differentials, which agree to, on the general info tab, this column. We add those up. They total 10,770. That reduces earnings. That's why it's a negative number. So I have adjusted net income, an increase in net income for the period 2013 after the adjustments of 167, 130. The non-controlling interest gets 20%. And then I also have to add on the impairment of the goodwill as a deduction as well. So goodwill is impaired, that reduces inventory, that reduces net income. And we will finish up the rest of the consolidated net income example on our next video. I want to thank everybody for watching. Remember that at St. Louis Test Prep, the website, we have accounting video textbooks. We currently have 2 textbooks, Accounting for Investments and Advanced Accounting. You can go out and get the video themselves, the Excel templates used to create the video, a practice exam in Excel with answers explained in the video itself also. Thanks very much for watching, and we'll see you next time.